Good afternoon. Happy Friday, everybody. This is Coach Mike on Friday, June 7th. Can't even speak today, right? Friday, June 7th. Recording the session that was live on Tuesday, June 4th. We meet the first Tuesday of the month, and this is just a recording of the session that we had a few days ago. So if you want to participate in the live session, send me your name and your email, and I'll put you on the list. And you can join into the live meetings. It's way more engaging. This is just a recording, a recap of what we talked about on Tuesday night. But if you really want to get the most value, you would join in on the Tuesday meetings. It's the first Tuesday of every single month at 7 p.m. and it's virtual. So without further ado, let's get started with this month's recap of the meeting this month. So I'm your host, Coach Mike, founder of Walk On Consultants. You see my website, my email, contact info right there. So feel free to reach out to me. Also offer a free 15-minute consultation, no strings attached. I'd love to coach you and make you a better investor. So who do I help? I help first-time investors who are still sitting on the sidelines. I want to convince them to get off the bench, get in the game, help separate the fact from the fiction and dispel some of the rumors and the myths and tame down some of the fears that they have about getting into the market. I'm like a personal trainer for fitness, your financial fitness, okay? And for those experienced investors out there who need someone to check in with every now and then before they buy something and maybe do an annual portfolio review, I'm your guy. Basically, I'm here to create a community of DIY investors, people who think they can do it themselves and want to learn and get better and grow and become a much better investor. I always begin with a quote from my favorite Benjamin Franklin quote is an investment in knowledge pays the best interest. And that's what I'm here for. I'm here to teach, learn, educate that everyone can get better at investing. Now, I got to point out that this is not investment advice, okay? This is the information for informational purposes only. I'm here to share information with you, more of a food for thought, and you decide whether it's a good investment or not, but I'm not providing investment advice, okay? And the reason is, you've got to know your risk tolerance. In order for someone to give you investment advice, you got to know a lot more about you. And I'm speaking to a wide audience. I don't know you personally, so I'm not giving you investment advice. This is general information. Now, along those lines, risk is different for every investor. Some people are more conservative. Some are risk takers. Only you know where you stand on this balance beam of risk and reward. But there's one thing I can say for sure is that there is a relationship between risk and reward. And if you don't take any risk, you're not going to get any reward. And if you take a big risk, you're going to get a big reward. However, there's a chance you may get a big loss. So again, you've got to decide where you are on that scale and that intersection of risk and reward. And it's different for everybody. So keep in mind that I'm not giving any kind of specific investment advice, but it's for you to decide where you are and where your comfort zone is. And sometimes you may have to get outside your comfort zone, but that's what it's all about. So please understand that. Last but not least, from time to time, you'll see me put out some links. They are from third-party sources, not from Coach Mike, not from Walk On Consultants, but the third-party links are where I got the information from. So let's get started. This month, we're going to talk about growth versus value. Which one is better? Okay, and probably the answer is it depends, right? So let's first talk about a growth stock, right? A growth stock, companies that are expected to grow sales and earnings at a faster rate than the market average. That's growth. They're growing faster than the market average. So here you got a bunch of first graders, right? This kid on the right looks like he's ready to go to middle school and probably in a year or two go to the high school prom, right? But he's growing faster than everybody else, right? They're all first graders, but clearly somebody's growing faster than somebody else. And that's the same thing when it comes to stocks, right? It's growing faster than everybody else, okay? Sales are growing, revenue's growing, hopefully earnings are growing too, right? But that's what we're looking for, growth. So this month, I'm going to highlight none other than Tesla, right? Clearly a growth stock. You look at the trajectory from 2015 up until now, and it's just been amazing. And so the earnings have grown, the revenue has grown, and so has the stock price. That's what we mean by a growth stock. So you got Tesla as compared to, well, before I get that, right? Let me say they started in 2003. They did an IPO in 2010, and it's been pretty much a home run ever since, right? Compare that to these companies that pretty much had a 100-year head start on Tesla, right? Look at Ford. 1903 versus 2003. These companies had a big head start. They're not growing as fast as Tesla because Tesla is the new kid on the block. They got a new technologies, electric vehicles, right? So now you understand what I'm saying a little bit about growth versus value. And I'm not saying that these companies can't grow, but they're probably not going to grow as fast as Tesla's growing because they're new. Now, so these companies probably fall into the category of value stocks, right? But they can still grow as well. But in comparison to a growth stock where it's growing faster than the average, value stocks, we're looking at the company itself and not so much doing a comparison to the competition, but is this company trading at a lower price than what it's really worth? Think about going to a thrift store or a flea market and you see something that you think's way underpriced and it's worth more than what you think is priced at. That's what we're looking at when we talk about value, right? Maybe it's a fixer-upper house that's a good house in a bad neighborhood. And you know, if I just put some money to this house and fix it up, it could be a great value, okay? That's value stocks. Something that's not being appreciated by the masses, but you see the value in that stock. You see the value in that fixer-upper car, that fixer-upper house, but other people don't see it. And then later, they like, oh, yeah, they catch on later, right? It's too late now. You made your money. None other than the famous Warren Buffett is a master at looking at undervalued companies, companies that for one reason or another fell out of favor and now they're down, but he sees the value and he invests in them when they're down and he's there when they come back. Nothing goes straight up. There are companies who are good companies that go up, 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 and then something happens. Maybe there's a scandal with the CEO. I'll give you like Chipotle a couple years ago had an issue with food poisoning, and I think they had a salmonella issue. So now the stock goes down, but Chipotle is a great company. It comes back. So Warren Buffett is the master at finding companies that are undervalued for whatever reason it may be. He invests a ton of money and makes a killing. It's called value investing. That's his strategy. He is the best at value investing. But I'm going to take a little quick side note here and say the originator of this quote said it a little different. Oscar Wilde, a famous poet and playwright back in the 1900s, actually died in 1900. What a shame. Died of meningitis at the age of 46 years old. Said nowadays people know the price of everything and the value of nothing. And oh my God, how that is still true today in 2024. People know the price of everything, don't know the value of anything. They pay way too much for stuff, have no idea what things are worth. That is still true today. So I just had to take a little side diversion, let you know the origin. You know, this guy also said, be yourself, everyone else is taken. Classic. So anyway, let's back to our regularly scheduled program, right? Talking about value stocks, right? Something that is trading at a lower price than its intrinsic or book value. So we got a couple of ways to measure what a company is worth. PE, which is price earnings, PB, which is price book, PS, which is price sales. You notice the theme is price in relation to the earnings, price in relation to the book value, price in relation to sales. It's not just the price, it's what am I getting for this price? And some people look at the dividend yield. Is the dividend yield pretty good? That's another indicator. So it's always about price in comparison to something, right? So let's take PE, price earnings ratio. It's the price divided by the earnings of the company. Remember, they have revenue, but then after you take out all the expenses, what did they actually earn? And then now I'm looking at the price I'm paying in relation to the earnings of the company. And if you Google, well, what is a good PE? You'll see that the definition, according to Stash, right? Around 20 to 25. Anything below that is good. Anything above that is bad. So if you take a look at the chart, you see General Motors and Toyota and Ford, they're all below the 20 to 25 range. And of course, Tesla, the outlier, it's above 20 to 25. So who's right? Who's wrong? Which one's a good value? Which one's overpriced, underpriced? How do we know, right? If 20 to 25 is good, these are definitely below that, you know? And so if you're a growth investor, maybe you look at Tesla. If you're a value investor, you look for something below that range. So just one metric that we can use, but I'm trying to give you some examples, some food for thought, and you decide which direction you want to go. So I got to put out a word of caution is that you got to be aware of the value trap, right? You're going to say, hey, why isn't my stock growing? You know, I'm trying to be Warren Buffett. I bought the stocks with the low PEs and nothing's happening. It's not growing. And you said to look out for companies with a low PE, right? It's something called a value trap. Well, what's a value trap, right? It's a stock that looks like it's a great deal, but it really isn't. So let's go back to the fixer-upper house, right? You think it's a great value, but it's in a really bad neighborhood. And that neighborhood never turns around. That neighborhood does not get gentrified. Crime goes up and the neighborhood gets worse. So it turns out it wasn't a good value, right? Or maybe you buy that car and it looks good on the outside. You open the hood, you need a new engine, you need a new transmission. So it appears to be a good value, but really isn't. So don't get caught up on just the PE. You got to do your homework and look at other factors. PE is one. Look at price to sales, look at price to book, look at the dividends. There are a lot of things to consider. PE is just one of them. So a lot of times people get stuck in this value trap, and I don't want that to be you. So do your homework, okay? Do your homework. Don't get stuck in a value trap or you'll end up like this, right? Smashed. So please be careful. Be careful. All right. So getting towards the end here, I just want to give you some examples. These are not exactly what I call value stocks, or maybe not value stocks, but here's the typical characteristics, right? Stable, mature companies like the Ford, like the General Motors, right? Stable and mature in their industry. McDonald's has been around forever. So is Hershey's and Disney. You get the idea, right? They got a long history. They're dominant in their field, and they normally pay a dividend. But something may happen, right? And they fall down, and you say, hey, this is a great chance to jump in. This company is a proven winner. Just because they're down right now doesn't mean they're not going to bounce back. And this is the chance for me to get in. So this is the idea of a value stock. It's got a good history, stable company, but for whatever reason, the stock market and investors are not feeling it right now, and just your chance to jump on in. So I know Disney had some issues during the pandemic. They couldn't go to theme parks. Everything shut down. Disney stock was down. Maybe you jumped in during the pandemic. Same thing with cruise ships and hotels. Maybe you jumped in. Great company, great history. So maybe you jump in. That's a value versus a growth. Growth stocks normally have a new product, a new service, a new technology. Think about Chipotle, Kava. There's another one that's Beyond Meat, right? DoorDash. These companies didn't even exist probably 10 years ago, right? If they did, they weren't public, right? So this is a growth stock situation like DraftKings, right? And FanDuel. They're a game changer. They disrupt the industry. But sometimes these growth stocks don't make it. They don't pan out. For every DraftKings and FanDuel, there was a company that didn't make it, okay? So again, there's risk in this situation as well. And it's up to you to decide how much risk is worth you taking depending on your circumstances. But growth stocks don't have a long history. They haven't proven themselves, like Tesla in the beginning. But you're buying them now because you believe that they're going to grow in the future. They're going to grow faster than the competition. So that's why you would buy a growth stock. So let's wrap it up here. You have the distinctions of what's a growth versus a value. You can see higher PE, lower PE, higher price to book, lower price to book. And of course, faster earnings growth, slower earnings growth. And a lot of times growth stocks don't pay any dividends at all. If they do, it's a very, very small dividend. So not saying one is right or wrong or which one is better. It's which one is better for you. It depends on you. You're the investor. It's your money. Which one is better for you? So in order to do that, the two most important things, what type of investor are you and how risky is the investment? All of the other things apply absolutely, but I think number one and number two is knowing what type of investor you are and how risky is this particular investment. Of course, reviewing the portfolio, rebalancing is important, staying abreast, looking at the quarterly reports, but you cannot ignore number one and number two. Second best way is make sure that your portfolio is diversified. I always show this chart. The S&P 500 is broken down into different sectors, 11 distinct sectors. And I'm not saying that you've got to have a stock in every single sector, but make sure that you don't have all of your eggs in one basket and that you do have a diversified portfolio. Whether it's tech heavy or not, just please make sure that your portfolio is diversified. I always say that learning is a journey. It is not a destination. I still learn new stuff all the time. So please make it a habit to keep on learning. So now at this point, I want to know what you think. Please put your comments down in the chat. If you were a part of the live session, you would have had a chance to engage in a nice discussion that we had about growth versus value. But since you're just watching the recording, put your comments in the chat. And please like, share, and subscribe. It really helps me provide more and more engaging content. I want to know what you think, what you like. It helps me produce better videos. So thank you for listening. This is Coach Mike signing off. Remember, reach out to me. Let me know what you, if you want to book a free appointment, I'd be happy to talk to you. And until next month, this is Coach Mike. I will see you then.